Happy Friday, Pat.
Hey, Brick, how you doing, buddy?
Oh, we're ready to go. We got new numbers to look at today. I'm going to do a little bit of a screen share. And you,
What?
Something right there. Is
What?
that a fly?
Oh my God, is that a fly?
Yeah.
Oh my God, is that the Trump fly or Joe Biden fly?
Yeah.
Holy mackerel!
You can just leave it there. That's what they did on the debate. So.
Yeah, it'll just stay there.
Oh gosh. Well, let's.
Got to throw a little humor in it, and some once in a while, right? Life is too short.
We have to. So, first of all, let's say welcome to our
God,
millions and millions
that's
of
annoying.
viewers.
I gotta distracting to me.
Yeah, I know. Yeah, I think you're starting to like it. So,
Yeah,
but hey, so
I'll feed it some water.
Here's what I'm going to do. Last week we did a real deep dive in the Cromford Index, looked at the CMI report and how it ties and tries to predict future price movements.
Yep.
So I'm going to show you some actual showing activity by price point in city, and we can kind of dance around the valley a little bit and see what's going on. But our inventory is coming up, but it's like not even a blip on the radar screen, and it's seasonal because we get more listings every October. But right now they're being bought so fast that the best way to describe it, it's like filling up a bathtub while the drain's open. We have 67 listings today, and last week on Tuesday was the first time in a few weeks that we didn't go down below 8,000 units, but they're still gobbling them up between 4,000 and 4,200 units a week. So we're actually adding about 200 additional homes every week, but that's not enough to turn the trend. That's for sure. But another interesting thing, in a typical week, so here's this week, we have 3,964 homes that are under contract and pending. So they're under contract and pending. And we only have 149 of those that are contingent. In other words, only 4% of all those listings are accepting contingency offers. I got to sell my house.
Mm-hmm.
I want to buy your house, but it's contingent upon the sale of my house. And those are always hard to navigate unless the market's so brisk right now, you can actually put your house on the market and then, get a contract and then go out, sign a contingency offer and say, look, I've already got a contract. But then here's what's happening on the other side now. Some sellers are pulling out the contingency plan that says, I'm going to accept your offer contingent on me finding another house. They're dusting off that old contingency offer. So the lesson learned here is, man, if you can avoid a contingency, that's the way to do it, because you can see that, only 4% of the homes in this market are accepting contingency offers. So it kind of knocks you out of the playing field.
Yep.
And so I'm going to share a screen here for just a couple minutes and show you what's going on with our showing activity and how we kind of look at it. So I'm going to share, let's see, this screen right here. It's going to look goofy for a second, then it'll get normal. And I'm going to show, where is it? I want to show this showing time. Can you see that okay?
Yeah, it's small.
Small? Okay, so I'm trying to think. I don't think I can make it any bigger here.
I just explain it probably slowly.
So see this long line here?
Yep.
That's a price point between 300,000 and 399, 999. And so I picked the city of Chandler. And what it's saying is there were 895 showings in a 7-day period in that price range. Down here on this bottom chart, it says that means we're averaging 8.69 showings per listing. Okay. Now, if I pick Gilbert, so I'll go down here and find Gilbert. There it is. Don't pass it up. Click submit. So Gilbert in that same price point's got 1,082 homes in that price point, and they're averaging 10.82 showings per listing. So 2 more. And then I'm going to go to Scottsdale because that one's kind of interesting because, that's where the higher priced homes are. So let's see what it looks like. Scrolling too fast. Here we go. It gets interesting. Look at that. Between 4 and 499. There isn't a lot going on in the 3 to 399 because there isn't that much up there. But there's a lot in 500 to 600 and 600 to 700. But their showings per listing, I mean, we've only got one that's over 5, 2 that are over 5. So they're not getting many showings per listings up there as they are in Gilbert. And what that tells you is if you aren't, if you're not getting at least one showing a day in this market, then you're overpriced. And one of the things I use showing time for as well, I'm going to go over here, is first thing in the morning, I pull a hot sheet. Shows me anything that's new in some of my targeted areas. So this is Chandler, Gilbert. And so let's say I look at this house right here and it's 347,000. It just came on the market. What I can do is I can go to, well, I'll be darned, this agent isn't using showing time. How bizarre. Here's one in Chandler. And I can go to showing time and I'll just pretend I'm going to make an appointment. Schedule a single showing. And I can see that they had one showing scheduled today at 5:15. Nobody has scheduled any on Saturday. So what that tells me when I look at that is that's a house that's not getting a lot of activity. Probably not going to be any bidding wars on that because only one person's scheduled to look at it today and nobody's made any appointments for tomorrow. Now, on the opposite side, if I see all kinds of appointments, then I'm going to call the agent even before I schedule it and say, looks like you have a lot of appointments. Do you have any, do you have any offers? So Silver Rose Gaming here, he wants me to look something up. Let me check, go back to that here real quick. So you look at Gold Canyon. So scroll down here, there's Gold Canyon right there. And in that price range, the popular price range is 200 to 299, 35 listings. It looks long on the chart, but it's only 35 listings. And the average out there is only between 2 and 3 showings a week per listing. So it's pretty slow out there. I'm guessing it's just because it's a seasonal area.
Yeah. So I'm sure it'll start picking up.
Yeah, it'll pick up in November, right?
Yep.
Other than that, you can drill down and you can look at things and say, well, how are townhomes doing? There's 72 townhomes on showing time that had 17 showings. Or no, 17 showings for 72 people. So, townhomes are pretty active in a lot of markets right now as people are feeling like they're getting, priced out of the housing market.
Yeah.
And I'm not seeing anything that shows prices are going to decline. And I know that New York is in deep trouble, Manhattan, but that's a whole isolated area and it's a different problem. Our unemployment numbers are improving and, it really gets kind of muddy now because you're starting to see numbers that look really good and then you see numbers that look really bad. Silver, because retirees buy in the winter. Yes. Well, they're not here. So, and it's going to be interesting to see in some of these retirement communities what's going on because, there's not a lot of travel going on. And now Fauci is telling us to skip Thanksgiving, large gatherings.
Mm-hmm.
So more turkey for me. So Pat, what are you hearing in the lending end?
Rates have been pretty steady. There hasn't been a lot going on. Obviously, from the rate standpoint, they've been quite eerily, quiet, as far as the refis are still been dominating, the activity for lenders, because like you said, lenders are 15 to 20 days in underwriting.
Yeah.
And in terms of basically, underwriting, I'm seeing, just really the biggest thing I see is, and I was on a webinar this week about the self-employed borrower. They have to obviously prove, they're looking at before COVID, they're kind of splitting up their underwriting into, you got to prove that your business has been stable during COVID and after COVID. So they're, asking for 2 months bank statements with cash flow, profit and loss statements. Like you said a couple of weeks ago, you just have to be really prepared if you're a self-employed borrower to, as they say, gird your loin and just, get all your paperwork and make sure that you're dialed in before you go looking for a home. And, have
self-employed, because they're really worried about, I saw a chart on bank reserves, and they really set a lot of money aside back in April because they were really worried that, we're going to have home loans coming back, commercial loans, car loans, and the amount of money they set in reserves, they've now pared back.
Yeah.
Mostly
there's still a ton. I was reading something. There's still a ton of people that obviously are pushing their payments back on student loans, car loans. So, there's still obviously the skeleton might be in that closet. Obviously, we've been talking about, but things have been moving along. Like I said, lenders have been pretty steady on the underwriting. Nothing too crazy that they're asking. Like I said, the biggest thing I'm seeing is self-employed borrowers. They're just you really have to, dot your I's and cross your T's before you go in and put an offer in if you're self-employed. That's the biggest thing that I'm seeing. And, appraisals are coming in strong. It's been pretty much same old, but like I said, the capacity is just, the lenders cannot catch up, and they don't see it. They don't foresee it changing for quite some time.
Yeah, I was told that the real catalyst for the buyers now, and the average buyer out there now is between 35 and 44. And that's the driving force. And which makes sense, because in my viewership on YouTube, the largest group that I have is between 35 and 44. Oh, and by the way, 67.3% of my viewers have not subscribed. So you see that button down there just below Pat? So click that. It just notifies you whenever we come on live or add any new content. But what was explained to me was for the buyers, the ones that are buying are like, yeah, I get it. The economy is probably going to, be tough for a while, but I have a good job and I'm not going to pass up this opportunity to lock something in for 30 years at this low of a rate. So yeah. I'm willing to take the chance. And that explains why these buyers are out there like crazy. And I'm getting emails from buyers going, we're outgrowing this 2-bedroom apartment. We want to get something, and now we're feeling like we got to get something before we're priced out. Once people really start feeling they're priced out, we're going to see this momentum slow down. And that's when inventory will start to take over, but we're just not there yet.
No, we're like you and I talked about this week, you eventually you're going to see buyer fatigue, where your buyers have been like this one buyer that, you have some buyers out there looking for 6, 7, 8 months. They're like, they just give up, they just give up for it. And, with rates being, like you said, I pulled up rates on a 5% down, loan. You're looking at, 2 and 3/4, 2 and 5/8, 2 and 3/4, 2 and 7/8 range, on 5% down. And you can get a great rate with, less money down. People think that, people still have a fallacy about down payments, and, they talk to their next door neighbor and saying, you got to put 20% down. That's the problem in the mortgage business, that, it's like any business. They always talk to somebody else, or next door neighbor that they trust, versus going to the, the real estate agent, or me, the mortgage guy, to really get the full story. Because like you said, 5% down, you can get in the high 2s, mid to high 2s.
Well,
Um,
are there programs out there that you can pay higher but get credit for closing costs?
yeah, yeah, yep. I mean, you pay typically if I could bump the rate up. Let's say I'm at 2 7/8. That's the par rate. Let's say I might be able to bump the rate up just a quarter point, and I might be able to get $3,500 in closing, and a credit from the lender to pay for the closing costs for the client. So it's not much of a bump in interest rate to obviously get a credit, to help for your down, for your not your down payment, but your closing costs. And that's another thing that people kind of miss when they're looking at a home. You got two components. You got the down payment, say 5%, but then you got the closing costs. And on the closing costs area, the lender can either pay for it in a little bit higher rate. Like I said, it's not that much higher. It's maybe quarter point higher. And with rates being in the high twos, if you bump it from 2 3/4 up to 3, you're still getting a great rate. But you're getting
that's something people should consider because there's a lot of buyers that go out and they get lured into these new home developments, and there's always more of a price risk in that because you're buying something new and then you're putting in your drapes, your yard, everything. You're spending all this money, and now you've got your own upgraded house, but they're still selling one down the street that's lower price than what you just put into your house, but they lure you in saying, use our lender and he'll give you, $6,000 in closing cost credit.
Mm-hmm. That's basically how they do it.
And so, but as a lender, you can do that too, but because they're doing that because they're raising your rate.
Yeah.
And then they're giving you all this credit. So you go into the new home builder and go, oh, well, they're giving me all these credits. Well, take a look at the terms. And so it's, they get all giddy when they see they can get $5,000 to $7,000, but they can also go to a guy like you on a resale home and pay 1/4% more and get enough credit to cover the closing costs as well. And you don't have to buy drapes. You don't have to, all the other add-ons and landscaping. So.
Yep. There's a lot to be said about that. I mean, it's a powerful tool. I mean, and your payment doesn't go up that much. It's amazing. Like I said, a lot of people don't know, that you can obviously put less than 20% down. Like I said, we talked about before down payment assistance programs, but you need a score of at least 660. The down payment assistance programs, your rate on the down payment assistance program, your rate's going to be about a point higher because you're paying for that money that you're getting. So, I mean, a lot of people don't know that they can get gifted funds from a relative. They can't get gifted funds from just a friend, relative meaning mom or dad, uncle, aunt, brother, sister. It's got to be kind of a related, fiance. You can get gifted funds. So if you got if you need 5% and you've got 2%, saved up, you can get the other, it can be a combination of a gift and your money.
Yeah, I should have been nicer to my family.
Yeah. So.
Hey, Eric, congratulations on the new house. He's thanking us for cranking out some videos here and saying he just bought in Arizona. So good luck.
Nice.
And I don't know if you just moved here.
Thanks, Eric.
What, but way to go. Yeah, I'm seeing activity picking up. I've got a lot of clients that are saying that they're going to be ready to go from December through March. Had a client reach out from California yesterday, a YouTube viewer wants to sell her house in Mirage and buy another one. She lives in California, but she's got her house out here in Mirage. And so that kind of activity is picking up. We're still hearing, I was speaking with another realtor earlier in the week and kind of shaking our heads. People go, I'm waiting until after the election. And it's like, look, there's nothing going to change between now and January.
I really do.
Which party gets elected. And I'm talking that way from a historical perspective because I looked at the data that shows, had the elections had any difference in real estate, the only difference is what you're feeling right now. And right now, buyer traffic is slightly lower this past 2 weeks than it was last month. And that's just election anxiety. But the trend of housing remains the same.
Yeah. You are going to, then you add in COVID, that doesn't help either.
Yeah, and there's just nobody knows where this is going to go. I mean, now you're getting all the reports that this fall it could spike up and it could go absolutely crazy, and we just don't know. Hey, Eric
Yeah,
is
I mean, go back.
from Seattle, my old hometown. Way to go, Eric! You'll love it here. So,
I'm not
um,
waiting.
yeah, what if we get another second wave of COVID? I don't see us shutting down. Do you?
No, I think we, I mean, personally, I mean, this is my Pat McMaster's opinion. I mean, we know how to handle it. I mean, we've got more therapeutics. So, I mean, you just got to be smart about it. I think, I just, if they shut it down, I think there'll be a revolution.
Yeah, I refuse to give up my antibodies, so I'm going to hang on to them. So.
Yeah. But to go back to the interest rates, so I really want I know I'm changing subjects real quick, but it's ADHD kicking in. Just going back to the bond market. I mean, like I said, it's been quiet, but the 10-year bond has been at 103.17, and there's resistance. It's really stuck in this bandwidth right now, and rates are probably going to go. Maybe if they go, the next break point is 103.50. So that means, the bonds could improve by 33 basis points. If something does happen, that's the resist. There's a resistance at 103.50, which means if it hits that, rates are going to go down a little bit, maybe an eighth, a little bit, maybe a quarter. If that's going to be tough, but there's been a resistance here that's been unbelievable. And like you said, I think we've been kicking around this. If you look going back to like March, we've hit this plateau or this bottom on rates. And for anybody looking for rates to go lower, I really don't see it. And if rates do go higher, that could be the catalyst that kind of slows this market down. But like you and I had said the last couple of weeks, I don't see rates. The Feds are going to keep them steady. And just based on my experience the last 20 years, they've been eerily quiet and steady. So something's going to bust out here. It's obviously the election is 2 weeks away. That'll probably bust it out somewhere. If I was to be a betting man, like I said, there's not much further. I don't think the rates are going to go, because another thing is too, people can look at the technicals on the 10-year bond at being at 103.17 right now. Or actually the U.S. Treasury's at 70.75. The lowest it got down was 0.50, but I just don't see. There's very little downside for rates going lower, and I think the upside is higher eventually.
Well, I know that quantitative easing is very confusing, and you see people feeling like quantitative easing is money printing, and that will cause inflation. And yet, then there's the understanding that quantitative easing is not money printing. It's the Federal Reserve purchasing treasuries, purchasing mortgage-backed securities and bonds, and letting banks have higher reserves so that they can lend more.
Yeah.
And so,
and when they buy too, they tighten up the supply. When they buy, there's bonds rates and yields go. When they buy, the yield, the price of the bond goes up and the yields go down. So there's inverse relationship with rates. So,
well, you look, and we've had quantitative easing now since 2008, and there was a lot of that going on, and we still didn't get above 2% inflation. And their target now is to be above 2%. The problem is there's only two places where the money's going, and it's going into the stock market and it's going into real estate, and it's not making its way into any other consumption. And that's why you see Fed Chairman Powell last week really pounding on Congress again and saying, you guys better get some stimulus money out there or we're going to be in trouble. And so there's this big battle between the Republicans and the Democrats. And even, not to get too political, but Wolf Blitzer was pounding Pelosi last week going, even your caucus wants you to take a look at that proposal that's $1.8 trillion. And she was just accusing him of not understanding the American people. It's like, No, the Fed chairman says we have to get some money out there.
Yeah.
And I just don't like that we're kind of getting addicted to stimulus checks, but it doesn't have to be stimulus checks. If the Fed is saying, look, money is cheap, money is free, I don't see a problem with instituting some large, massive scale infrastructure projects that put people back to work, that get money circulating into the economy. There's plenty of bridges we can fix around the country. And now's the time to do it instead of just mailing people checks.
Yeah.
And,
people checks. You need velocity of money. You need velocity.
there is no velocity of money when we look at the Fed charts. The chart shows, the Q2 or whatever it's called, M2 going straight up, and the velocity of money is going straight down because we're scared and we're hanging on to it, keeping it in the bank.
Well, it's like on refinances. Basically, refinances. If you think about it, when I do a home refinance, there's no velocity. Like when I do a purchase, there's money going in. They're creating new money. Just to make it simple in the mortgage market. But in a refi, if I refinance for somebody for $300,000, I'm just changing the lender name. That's all I'm doing.
Yeah. You're not. You may indirectly be increasing some of their spending because now their payment's less, and maybe they'll get a car, or maybe they'll, but as a rule, they're refinancing and paying off other debt.
Yeah, typically what I'm doing right now, the last 6 months, is basically I'm doing a VA IRRRL for this lady, this veterans, VA loan IRRRL. I'm dropping her rate from 4.25 down to 2.375. And I'm dropping her loan she's been a year into it. So I'm going from a 30 down to a 25. So she's also lopping off four years of her loan. And she's still saving about 100. I think the numbers were like 160, 50, about $50 a month. So, she dropped it from 4.25 down to 2.375. So, just a lot of people reducing their term. I'm noticing, a lot of people, there's not a lot of, I haven't, like I said, the cash outs, I try to basically discourage because of the pricing hit on the whole loan amount. But, there's a lot of people last year and a half that have refinances. There's been a lot more smart money the last year and a half. Back 10 years ago in 05, 06, people were taking out $50, $60, $100,000 of cash when they saw appreciation in their house and they were buying a boat and a car and this. Now people are just, they got burned. They're smart. They're like, I just want to reduce my term. If I reduce my term, or if I reduce my, go from a 30 down to a 15, my payment's going to go up, but I'm going to knock off 15 years, and I'm saving. This one gentleman several months ago, I figured out the numbers. He was going to save $175,000 in interest on his loan.
Yeah.
So there's a lot. If you put $200, $300, $400 of money back in people's pocket, they're going to become a lot stronger.
We shifting gears just a little bit. Last week we talked about days on market, and right now the average days on market are 45. What's confusing?
I don't believe that.
What's confusing about that is it makes someone think that it takes the average person 45 days to sell a home. But I got the actual numbers here. Half of all listings in the third quarter went under contract in under 9 days.
Yeah.
So the 45 you're seeing is from the time it was listed to the time it recorded. So
and the lenders are taking. So that includes a lender when they're doing a loan. Yep. And the lender, that makes sense because the lenders typically, I saw a stat by Loan Tracker. This one stat, they said 70% of the loans are taking 35 to 40 days to close.
Yeah, it's dangerous out there now to plan on moving in 30 days. If you've got, your mover coming and then the other person is packing, getting ready to leave, and, you need to be flexible. So you need to, I suppose you can shoot for it, but then you got to be talking to your lender and saying, if you're a buyer, let the buyer's agent know we're going to do our best to close in 30 days, but we're both going to have to communicate in case we have delays in appraisal and underwriting.
Yep. One thing to note too, as a lender, what I do is when I get a contract, you've seen it. I mean, I'll talk to a listing agent, talk to the buying agent, I'll talk to the buying agent and say, hey, what's our scenario look like? Is this house empty? The lender should be asking what scenario do I have to work with right now? Because you got to be prepared. Now, if I'm a lender and let's say I got a 30-day close, and like this one I got right now, we're a couple of days past. The lender's backed up. It was 2 days to get the CD out, and it's taken 2 days to get docs out with some lenders. But I asked them, I said, and the listing agent said, don't worry about it. The house is empty. The buyers, the sellers have already moved out. So that gave everybody some wiggle room versus, we got the seller. They're going to be moving out on Friday. We've got the buyer having their moving truck on Friday morning. You really got
they need the money because they're getting another house. I mean, it's like you're just juggling.
You really got to take that into consideration. I mean, any lender that's doing a loan for anybody out there, that's really what I get dialed in first is what's my scenario on the back end? What's the back end look like? Just in case I need a little wiggle room for 2 or 3 days. Because, if I do get that scenario where, the seller's selling on Friday, they got to use these funds to buy another house that's contingent. That's the worst thing is when you got the buy and the sale of a purchase of a house, and it's contingent on there's like a log jam. There's 3 or 4 other deals that are contingent on this because if that seller is selling a house, he's buying another house, he's buying a house that the other seller's got to, you got this log jam of situations. So you have to really.
Well, I had a nightmare scenario a few years back where we accepted a contingency. The agent failed to tell me that the house that was being sold, they said it's already under contract, didn't tell me that the people that were buying that house, that theirs was also, they accepted a contract under a contingency. So it was it just felt like a house of cards, boom, boom, boom. It's like, what?
And that's sometimes that's stuff that you'll find a week and a half before. And that's something that I try to find out right in the beginning, the first day or two. Is like, okay, what scenario? You've heard me talk to you. I mean, in situations, what are we looking at? Is the house empty or is it, what do we have to deal with? And that helps the situation tremendously when and I think 9 out of 10 lenders or, the listing agent doesn't communicate that or the buying, you're great about that. I know that. But there's some agents out there that they don't put that scenario in front of the lender to say, hey, we got to push on, I'd say I've had that where they said that, but there's a lot of cases where it doesn't come up in conversation at all.
Yeah.
So it's just that.
I got a couple of questions here. One from Silver saying, how's the Oro Valley market? I don't have access to that data. It's in another MLS, so I can't see what's going on there. But this one says, I think the crash will happen next year gradually until 2022. Take a look at our video on YouTube from last week. We did a deep dive on the numbers that we're seeing that are telling us that there isn't a crash coming. And we spend a lot of detail on that. And I know there's a lot of people out there that are waiting for it and actually kind of hoping for it. But I'm not seeing it. I was very pessimistic about housing in March. As soon as we got the stay-at-home order, this is it. I mean, I don't know how we're going to survive this kind of an economic hit, but looking at the numbers every week as we have, I'm no longer in that camp. I mean, I'm like a politician that says, I didn't believe in this, now I do. But I believe we'll see some softness. I just don't know when. The numbers we see now are telling us it's not going to be next year because our inventory will have to quadruple quickly before we see any dip.
And, I once again, I mean, for anybody that says that, I appreciate their, the comment. Lived the nightmare because I got in the business in 99. I lived that nightmare from 03, 04, 05. I saw the buildup and I actually commented to about a half a dozen friends and they were amazed at how correct I was. I told a buddy of mine in 07, when we saw the crack in February, March of 2007, I saw the loan really starting to crack. And I told a buddy of mine, who was a real estate agent at the time, when we were heading down, I said, we're going to be in this thing for the next 5 to 6 years. And he goes, and we were there for 5 or 6 years. So I lived 08, 09, 010. I'm telling you right now, there's nothing close to what, from our standpoint, from a lending standpoint, the loans that were written in 05, 06 were absolutely horrendous. Interest only. I mean, it basically, the reason just to break it down, I mean, like we talked about, I had buddies of mine go out and buy 4 or 5 homes, no money down, interest only. They could buy an investment property with a 620 FICO score.
Oh, it's worse than that. My ex-wife bought a house and her only income was my alimony for 4 more years. And they
yeah. So
what are you going to do for the next 25 years?
The underwriting standards were atrocious. I mean, they were absolutely atrocious. I mean, I got sick when I sick to my stomach when I see some of these loan programs. I'm like, this is ridiculous. You had the pay option arm loans, the interest only loans, the negative, and negative amortization loans, the loans with prepayment penalties. I'd say I'm going to equate that crash. About 90% of it was just the crappy loans that were written, and because you could have a Joe Smith go and buy 5 homes, and then when it started going down, when it started kind of breaking, if he had 5 homes that he had no equity in, he would just let them go. He's like, I'm done. So he had 5 homes go, 4 homes will go. You had people that were just letting these homes go. So you don't have that now. You've got the underwriting standards are just ridiculously 180 degrees.
Yeah, we can't predict if house prices are going to come down. We
But
can
it's
only look
often,
at data and tell you what they're doing now and what it looks like a year from now. Beyond a year from now, we're just pretending we have a crystal ball.
Yeah.
One of the scenarios that could happen is that maybe house prices will stabilize, but wages will catch up. So one of 2 things has to happen. And if the feds are trying to get inflation at a certain rate, it's highly possible in a tight labor market, the wages will accelerate and start to catch up. And if house prices stabilize, then, it's really important to be looking at the payment and not the price of the house in most cases.
Yeah.
And now California is a different ball game. They're really high. Las Vegas is getting their butt kicked. Their economy is just in dire straits. And I used to manage Las Vegas in my previous career. And so I've seen what happens out there when people don't go there, and they lag 18 months behind the general economy because none of us go gambling until after we've had our job secure and got it back for a good year and a half. California, they've got another whole host of problems, beginning with taxes and infrastructure and regulation. And so that is adding to the stress of people wanting to get out, but they're still selling houses. So it's, we're living in this weird world right now. And so I think, and who knows, maybe Arizona will end up being priced out of the stratosphere, but the other danger is we're going to run out of water if people keep moving here. So, it's a tough one. People are going to Coeur d'Alene, Idaho in droves, just crazy. So, Silver Rose says, I hope California doesn't crash. I need to sell this place. That's, everybody wants prices to go down unless you're selling. Then, it's tough. It's just, all I can say is just watch the local inventory numbers in your area. That's why we look every week. And I tell you, we've got 8,767 homes available in this market. Home prices are not going down until that level of listings gets up to around 20 to 30,000.
Yeah.
And even then, that's considered normal. So that's the scale of how much inventory has to grow. So
and I think it will, like you said, this is not going to last forever. It's going to, but people are saying if it doesn't last forever, they're going to go the flip side. There's going to be a crash. I think it's going to soften, but if it softens, it's going to, there's just a lot of demand out there.
Yeah, it's crazy.
All right.
My computer's calling me, and I've never figured out how to turn that off.
Probably telling you a happy hour. So,
I
all righty.
guess something's going on. So, well, Pat, we'll call it a draw here for until next week. I think, the closer we get to the election, it's going to be more interesting to see just how much anxiety there is that drops the number of contracts. Because right now it's hovering around 4,000, and it was going around 4,400 a week. I expect that to go down another 200 to 400 in the next 2 weeks. And so we'll see, but again, that's not enough to have an impact.
I just thought of something. I think it's going to be very interesting based on your number tracking the last 5-6 months. It's going to be very interesting to see, and hopefully people will tune in. I'm going to be interested myself to see, maybe not a week after the elections, but let's say 2, 3, 4, 5 weeks after elections, because you're going to have a lot of stuff. This moratorium on rents ends December, January.
There's a lot of things in the basement.
Yeah. So it's gonna be interesting to see. I mean, I maybe not a week after. It'd be interesting to see after a week to see what the numbers look like. But we got, based on you tracking it the last several months, it's gonna be nice. We got a baseline to work off of.
Yeah, and then so most of the forbearances expire in March. That's their 1 year, so they expire. What happens then? And the difference between now and 2008, now you got these iBuyers that can come in and scoop them up if you're behind. Zillow and Open Door may be the people that say, oh, we see an opportunity here, let's go grab these. Because they have access to that data and we don't. They have systems and analysts and access to who's not only in forbearance, but who's pre-foreclosure. And they may have an opportunity to go in and pick some of these up, and people out there waiting to buy a foreclosure are like, well, I'm not even seeing any foreclosures. Where are they? And we did, and as a reminder, 99 foreclosures last month. And during the dive of 2008, we were averaging 10,177 a month.
Yeah. It was like
to answer Rose, let's see, the name is Any. Any name, I guess. So she says, according to lending data, I see no growth in the economy. It's hard to believe that wages can keep up unless the economy can grow without lending growth. That is a true statement and couldn't be more true. But their intention is for the economy to pick up and for lending growth to grow, because we are a debt-based economy, and for people to go back to work. They want to get our unemployment levels back down to 3%. So the clock is moving way forward on that. And if they're successful at that, wages will increase. But it's a tall order.
Yeah, exactly.
Because it's going to have to happen globally, to be honest with you.
Yeah.
So, all right. We'll have a super weekend, Pat.
Yeah. I don't know where that, hopefully I got rid of that fly.
Yeah. It's tough. But I know you're going to have a better weekend than me because I'm helping somebody move. So.
Oh, you're a good friend.
Yeah, I don't know how I got roped into that. So I don't even own a truck. All right, see you later. And thanks to our millions and millions of viewers.
Yep. Say hello to everybody.
Okay.
Bye.